stocks is not a pure science, else all finance people would have been millionaires and billionaires. It is a part science and part controlling emotions. There are many websites and techniques to help you take care of science part, but tackling the emotional part is a big challenge. Thus, it is very much essential for especially the retail investors to understand the broader view about the economy cycle and investors' behavioral pattern. To understand this concept, we have created an analogy with a seasonal fruit-bearing tree. For clear insights, we have designated trees parts as main trunk, place for large cap stocks, less fruits but reasonably safe place, branches, mid cap stocks, good returns but risky place, picks, small cap stocks, reasonably good returns but highly risky place. Investors climb up and descend the tree as the season progresses. Read economic cycle. To begin with, we are at a stage where a small set of smart investors start climbing the tree when they sense that fruits are likely to appear in the coming times. Steadily, more and more investors join them as they too could see the growing numbers of fruits and some previous investors even eating the fruits. Fruits are visible and are still approachable from the main trunk of the tree, thus risk is low. The pace keeps increasing and time comes when the speed is fastest. At this juncture, about 30 to 40% investors are on the tree. This trend keeps rising, and even those who never climbed the tree also start climbing. These investors do not want to miss the chance. The fruits on main trunk are depleting fast. Investors start approaching main branches where there is risk, but the greed overtakes it. Those standing on the ground feel left behind. The guy standing beside some time ago is also eating the fruits with hardly any efforts. Many of these first-time investors never even thought of climbing the tree also joined the bandwagon. On reaching the trunk, they find no fruits. So they approach towards branches where only some fruits are left. Being late in climbing the tree, they move towards twigs. These are small and thin branches and get hold of ample fruits. Others sitting on trunk and main branches feel that these guys who joined late are enjoying the most. Many of these investors too approach towards the twigs. In the process, twigs loaded with investors start getting mowed down. Almost all investors are invested. Hardly anyone is left. This is the peak of the market. Suddenly, breeze starts blowing. A stage comes when one of the twigs gets extra loaded so much that it breaks down, even with a little breeze, and all investors on the twig fall down. Those on other twigs get cautioned, but they believe their twig is pretty strong and sustainable. Meanwhile, few more twigs get broke. Breeze soon takes the form of strong winds. More twigs develop cracks and ultimately wreck. Many of those still sitting on the tree climb after lots of study about the fruit's strength and risks involved start losing confidence fast, though they are sitting on strong branches. Instead of continuing, they decide to step down. Those having no knowledge as well as those with full of knowledge about value creation are investors who start quitting because they are unable to hold the emotions. Strong wind turn into storm. Majority of left investors lose patience as there are hardly any fruits left and time spent on the tree does not seem to be worth to wait for next crop of fruits. They choose to step down. Now only few investors are left on the tree. Hardly anyone is climbing but few still descending. This completes the one cycle. We are again at the bottom of the cycle. You must have observed that about 10% investors are always sitting on the tree, come what may. All times are good to invest if investor has the eagle's eye. Now you will appreciate one of the main reasons for underperformance of mutual funds. Majority of investors invest in mutual funds when the market has already gained significantly from the last bottom and there are not many opportunities left. Also, they withdraw when stocks have fallen significantly from the last peak. That is when fund manager is in need of money. How can you expect mutual fund to perform widely better than the underlying index? Advice for investors. For new investors, they should start investing with well-established large cap stocks. They should avoid mid and small caps. Investors with an experience of at least one crash should invest in mix of large and mid caps. And investors with an experience of at least two crashes can invest with a mix of large, medium and small cap stocks.